Hi folks, and welcome back to Meaningful Money. Okay, I'm still here high above Sennen Cove, see it there? And this time we're talking about corporate bonds. Talked about gilts last time, and corporate bonds are very closely related cousins. But before we do that, I must thank my friends down here in the bottom right. That's Seven Investment Management, who continue to sponsor me here, for which I'm really, really grateful. Apologies for the mic, by the way. Problems with my Thai mic this morning, so this is, quick fix really, but hopefully it'll work. We're updating some of the really old, really early episodes because video and audio quality is much better these days. So this is an update of episode 30. Now, a corporate bond is very similar to the gilts we talked about last time in that it's an IOU, but rather than an IOU issued by the UK government, they are issued by companies. So if a company wants to raise money, they can either issue more shares, which has implications for existing shareholders and things like that. They can go to a bank and borrow money that way, or they can issue the corporate bonds. Now, all the same things really that I talked about gilts apply to corporate bonds as well. Essentially, it's an IOU with 3 bits of information on it. Do you remember that? So we've got the amount borrowed, the length of time or the date that they will pay me the money back, and they've got the interest rate they will pay me in the meantime. The main difference, of course, is that there's only one UK government issuing gilts. There are other governments issuing their versions of gilts, like the US Treasuries, they're called, and things like that. While there's only one UK government, there are hundreds of thousands, millions probably, of different companies issuing corporate bonds. So there's a wealth of choice out there. So let's just look at an example. I'll just shift across and bring in a little bit of a graphic, because let's say Unilever wanted to borrow some money. Massive international corporation. You know, if they borrow some money off me, they're going to be probably a pretty safe bet, right? The chances of them defaulting on that loan and not being able to pay me back in 10 years' time are pretty slim. And so that is a good quality company, and they will issue a good quality, what we call an investment grade corporate bond. Now, at the bottom end of that scale, I'm going to use my little company, Jackson's. My colleagues would kill me for doing this, but because we are a small company, there is greater risk that we might go out of business and therefore not be able to pay you back if you are a corporate bond lender. And so we've got a scale here, and a quality scale, let's call it. So we've got high quality at the top and lower quality companies at the bottom. Now, on the other side of that scale is the income that you're likely to get, because can you see that if a large quality company who's very unlikely to default on the loan, they don't have to offer very high interest rates in order to attract people to lend to them. And so, you get lower interest rates at the top, whereas at the bottom of the scale, the lower quality companies, because there is a higher risk that we might not be able to pay that money back, we have to offer higher interest rates in order to get people to lend to us. I should stop saying we don't do this, right? But lower quality companies will have to offer higher rates to get people to lend to them. And so you get 2 sides to this scale. You get higher quality companies at the top, which offer lower interest rates, and at the bottom you get lower quality companies which have to offer higher interest rates or high yield bonds. And you've got a whole scale and lots of shades in between. And so if you are investing via a corporate bond fund, well, that fund might decide just to concentrate at the top of the scale and just deal with high quality but lower interest rate bonds. Up at that end of the scale, corporate bonds behave a little bit like gilts. But you may have a fund which might often be called a high yield bond fund. They might just deal at the bottom end of the scale, where you're going to get more income, but there's the higher risk of those companies defaulting. And down at the bottom of the scale, corporate bonds behave a little bit more like shares. Because remember, these things are traded on the stock market, so people want to buy at different points, want to make some money on the capital value, they want to secure the income. There are complicated things because they're traded. But a fund, perhaps a strategic bond fund, might be able to go anywhere on that scale, depending on what they feel about the corporate bond market at any given time. So this scale is really important, but that said, I'm going to get rid of it. Corporate bonds behave differently depending where you are on that scale, and so a good fund manager will be at the right point on that scale at any given time, but it might be that you have a fund manager which just focuses on one area of that scale. But because they behave like themselves, they are corporate bonds, and there's something like, I should have looked this up, something like 4 times as many corporate bonds traded in the world than there are shares. It's an incredibly important asset class. It's really important that you hold them in part of your diversified portfolio. They're deemed to be lower risk generally than shares, but that's a gross generalization because down the bottom of that scale, they behave quite like shares. So that's corporate bonds in a nutshell. Hope that makes sense. As ever, leave any questions under the video. I'll do my best to answer them. But for now, thanks for watching. We're going to look at shares next time. Again, updating actually one of my favorite videos, number 31. So thanks for watching, and I'll see you next time.